In this video, I want to show you a trading strategy which I created for a Forex market back in 2016, and it has an equity curve that looks a little bit like this. And as of today, in September 2021, it's still making new equity highs. However, I did stop trading it live after only about a year of trading it. Firstly, let me show you how the strategy works, because the principles apply to all other markets too. And then I'll talk about why I've stopped trading it. Entries and exits are pretty simple. I'm looking at how the market behaves during the day. So this is a day trading strategy. I'm looking at an hourly bias. I managed to find a period of the day, an 8-hour period, where Euro-Pound Forex pair tends to rally strongly time and time again. However, I didn't find a period where it tends to decline regularly during the day. So for this strategy, it's just a long only strategy. I want to note that I first found this bias or this behavior in Euro-Pound back in 2016. And as you've already seen by the equity curve that you saw a minute ago, this bias is still present today, so that's more than 5 years later. Quite pleasing, especially as I was very new to creating algorithmic trading strategies back then. The strategy is simple, so all we do is we go long at 2100 and we exit 8 hours later at 5 AM and use a 60 pip stop loss. However, I also introduced some filters to only take the strongest signals. The bias or the strategy edge still exists without the filters, but it's certainly not strong enough to trade. Anyway, let's go over to the computer and we'll look at the performance reports, and I'll demonstrate and explain why I stopped trading it, although it actually on the surface looks very good. And hopefully it will stop you making the same mistakes that I did. In this first chart or workspace, I have data which I used when I originally created this strategy, and I used data from 2008 through to the end of 2015. I created this strategy in August of 2016, so that left me sort of 8 months or 7 months of out of sample data to work with when I was creating it. So I'm going to apply the strategy to this set of data, and we have a look at the equity curve. You can see the trades here. Like I said, we're buying at 2100, exiting 8 hours later. We buy 2100, exit 8 hours later. However, I do have some additional filters. That's why we haven't got trades every single day. Let's look at the equity curve. And that's the equity curve. And I think you'll agree that that's quite a nice equity curve. Remember I said it was a long only, so no short trades, just a long only. And there's the equity curve. Moving on to the next workspace, I've included data, I'll show you, from 2008, so we're still going back to 2008, but I've got this through to around about the present day, which is 1st of September 2021. So we've got a load of forward data, and let's look at the equity curve. And you can see it's still really nice. If I hover over where we had the data up until in the previous workspace, which was the end of 2015, so about this point here where my arrow is, so from here then on, that's how the strategy performed after I created it in forward testing. So that's exactly what we want to see, so that's really good. So essentially what that means is that the edge that I found, or the bias that I found in this case of this strategy, still exists even 5 years later, and it's still working. So why would I stop trading it when the equity curve looks as good as that? Quite simply, the strategy isn't good enough. The equity curve that I've shown you of the backtest didn't include any trading costs, such as slippage, commissions and spreads. Once we include trading costs to a backtest, then the results obviously get a little worse, but they become more realistic to live trading. So next, what I'm going to do in the next workspace, I'm going to add £50 worth of costs per trade. Now, the test is done using one full lot of Euro-Pound Forex pair, and £50 is equivalent to 5 pips, which is a little bit large for this strategy, so I'm slightly overestimating the costs, but it's better to overestimate than underestimate. And I wanted to overestimate it ever so slightly just to prove my point about why I stopped trading the strategy. So let's have a look at that now and see how that's impacted our equity curve. Before we move across to the workspace with the added costs, I just want to show you the average trade value. We've got an average trade value of £72. What that means is we've added up all of our winners added up all of our losers, and then subtracted the losers from the winners, and then divided that by the total number of trades, and that gives us a value of £72 without any trading costs. Now remember, in the next workspace I'm going to add £50 of trading costs, so that's going to take up the majority of this average trade value. So in this workspace we've got the trading costs added, and looking at the performance report you can see now the average trade is £50 less, so it's come down to only £22 per trade, and £22 is just a little bit small for profit for my liking. So let's have a look at the equity curve, and you can see the equity curve is definitely worse now. And look at the period from where we originally had, from about here, which is the end of 2015, we had a massive trade here. But then essentially you could argue that equity has pretty much gone sideways for the next 5 years. In fact, the only really good bit was down here early on, and a little bit here, I guess, if you'd stop trading it at this equity high here. But you can see how drastically the equity curve has changed by adding in those trading costs. So while I'm very pleased that my edge, or my strategy that I discovered or created more than 5 years ago, is still working today, we saw that by one of the first equity curves, it just isn't making enough money for me to bother to trade it live. Sure, it made a tiny bit of profit for each trade, but quite honestly, as I began to develop and create more and more strategies, better strategies, then my money is better allocated on strategies elsewhere than this one. But 5 years ago, I was new to automated trading. I had a new strategy, equity curve looked great, and I was as keen to get as many live strategies going as possible. So that's why I initially traded it. And then after assessing it, after that first year or so of trading it, decided to quit it and allocate that money elsewhere. And nowadays I just concentrate on strategies which have some larger edges. If you've seen many of my videos before, you'll notice that I focus quite a lot on the equity curve, but also on that size of the average trade. And I mean, quite simply, the bigger the average trade is better. However, it sometimes is a balance between having a strategy with fewer larger average trade trades, or many with smaller average trade trades. Anyway, the two key takeaways that I want to give you from this video are: number one, be mindful of the size of that average trade. Don't just look at the slope of your equity curve. And number two, creating strategies that use biases, like looking at the hours of the day or trading day of the week. You've seen many of the biases that I use. Using those sorts of strategy can work really well into the future. You've seen that buying at 2100, selling at 500 on euro pound has worked well into the future after I developed this strategy first. So that's about it for this video. I hope you've enjoyed looking into one of my own personal strategies that I trade, and if you found it useful, then please give the video a thumbs up. But until the next video, this is Jared Goodwin, and thank you.